And good afternoon, folks. This is Stacy Acevedo, and welcome to your 8th video in the cash flow strategy session. We're going to be talking about our credit spreads here. And before we get involved, just keep in mind that there's risks in the stock market. When you're trading stocks, options, futures, anything out there in the market, you're going to have fluctuation, and there's no guaranteed of any types of returns. But that's why we educate ourselves on the risks associated, so you know that this is going to give us a much better playing field. If we can avoid the risks, then we can go toward directly where the profits are. Now, in our 8th video, we're going to be covering what's called credit spreads. The first type of credit spread we're going to take a look at is called the bull put spread. Now, this is very similar to the naked put that you just learned about, but in this case, we're going to make sure that we're not going to be naked, because naked means you're really exposed out there. So we want to make sure that you also have some type of protection here. So what we're going to do is we're going to buy the lower strike price put. By doing so, what this is going to allow us to do is to free up our margin. So for example, when you learned selling naked puts, which by the way is a fantastic strategy for traders who maybe are more advanced or have gone through your advanced technicals. Because when you sell a naked put, you're going to sell, in this case, a $25 put. Maybe you pull in a premium of $2. Now, the margin needed is usually about 20% of your strike price sold, which would be about a $5 per share amount of money on margin. And that's great because you're pulling in a very nice profit, but the problem is you're going to have a lot of dollars of invested money at risk. That's why many traders will turn to what's called a credit spread or a bull put spread. So we're going to start the trade the same way, in the sense we're going to go ahead and sell the $25 put and receive our $2 credit. Now that part's great. But what we're going to do now is we're going to actually go in and we're going to buy some protection. It's always really good. So let's say if this is our support area of $25 and we're say, I think the stock is going to stay above that. Again, this is a bullish trade. So as long as the stock will stay above, any money that we sell at this strike price will remain in our favor. But just because we're kind of new and we never know what the stock market's going to do, we're going to buy some protection down here. We're going to go ahead and enter a lower strike price, a lower put, and I'm going to buy that just in case. So in this case, I'm going to go ahead and buy the $22.50 put right now. And what this is going to do is it's going to reduce my money at risk from the strike price I sold at $25 to the strike price that I bought at $22.50. So now instead of $23 invested at risk from your strike price all the way down, less your premium, now you're only going to have the strike price that you sold to the strike price that you bought at risk, less your initial premium. So in a bull put spread, again, we're going to start it the same way. We're going to sell the $25 put for $2. Then we're going to start looking for some protection. In this case, I can buy the next strike price down, which would be the $22.50 put, and that'll cost me $1. So if I can bring in $2 and buy protection for $1, I'm really netting here an overall $1 per share on this trade. Now that's still very, very nice trade. And the best part really is only the money that's needed in your account now is really reduced from your margin of $5. We only need the difference between the strike price you sold of the 25 put to the strike price you bought at the 22.50 put, which in this case is $2.50 minus the $1 that you just brought in. So of a net premium, which means you're going to need the $2.50 minus the $1 net profit. So of your $1.50 of invested risk, you've already pulled in $1 profit on that. Now the bull put spreads, these are designed for different types of stocks that you think are maybe headed more of a neutral to a bullish pattern. And again, we're doing this because we don't want to be naked in our trades. So let's go ahead and continue on and see what would be some ideal scenarios and how to actually place this trade and what to watch out for. So in a credit spread, what we're looking for is we'd like the stock to stay away from the strike price you sold. On a bull put spread, we would like the stock to trend higher and move away ultimately from the strike price that we sold here. We'd like the stock to close away from our break-even price, and I'll get into that in just a moment. The break-even price would be the strike price you sold minus the premium that you've already received. The premium between your strike price and your premium, there's going to be a safe zone involved here as well. So we're really allowing for a stock to move potentially in multiple directions. So ideally, a bull put spread, we want the stock to be trending higher, and we'd like to have the options expire worthless. In a bear call credit spread, we would like to, as it says, have the stock be in a bearish mode and for the stock to be trending lower as we enter into a call credit spread. Ideally, we would like the stock to move into a fashion that if we could find a stock that's potentially headed lower, and we could sell some calls up here, and if we could find a stock that's maybe headed higher than this range and sell some puts here, these are called credit spreads. What we're doing is bringing in a premium if the stock does not go above this pattern, and then we would bring in a premium if the stock does not go below this pattern. These would be calls and these would be puts. Now individually, one is called a bear call spread and this one is called a bull put spread. You'll notice as we go on in your training how we can actually take advantage of this for new traders and potentially bring in even more cash. But for now, let's take a look at a bull put spread ideal scenario. We would like our stock to close above the strike price sold. So let's take a look at, if I were to sell the $25 put right here, and I'm going to say I would like the stock, I'm allowing someone to put this stock to me if it goes below this particular strike price. So clearly I'd like for a stock to move neutral to possibly even up. That way whatever I pulled in right through here, this $2 premium expires completely in my account, my overall profit, which is fantastic news. Now, keep in mind, we're always going to buy some insurance. Folks, when you're brand new, there's so many things about the market that you may not have learned just yet. So we always want to be safe and buy the next lower strike price for some protection. That way, the only amount of money you have at risk would be the difference between what you sold and what you bought. And ideally, gosh, if we could keep this stock and staying above the strike price that you sold, then all of the money that you brought in, the premium that you brought in minus the premium that you paid, all of those profits, those stay in your account and you don't have to pay any extra commissions. This is the best part. If you can enter into a credit spread and receive the premium initially, ideal scenario is on expiration day, both options expire completely for a profit and there's no more commissions to close the trade. Now, a secondary scenario on a credit spread would be, let's say the stock maybe is headed up. Let me show you what I'm talking about. You think the stock is certainly headed up, but for some reason it gets a piece of news and then slightly comes down below our strike price. So if here's the $25 strike price that we sold, and we think, yeah, if the stock heads up, it's great. If the stock heads sideways, that's okay too. But if it heads down, we'll potentially have some money at risk. Now keep in mind, your in this case scenario, let's see how much we're only at risk between the strike price that we sold, in this case, what you sold, and what is your premium that you pulled in. There's a safe zone right here. So let's say in this case, maybe you received $1.30. If you, in this example, if you sold the $25 put, and you're saying, okay, if the stock goes below this strike price, sure, I will buy your stock at 25. I will allow you to put it to me. Now, because you think the stock is going to be headed up or even sideways overall, but for some reason the stock gets some bad news and it comes down below your short strike, now you bought protection down here at the 22.50 overall. So let's say this is one of the scenarios. If the stock does come down to your strike price you sold, again, you're vulnerable, the price you sold to the price you bought. But because you had already pulled in $1.30, anything below the strike price you sold minus the $1.30, this is still a profit, folks. So let's say the stock closes at $24 per share. Now what happens on expiration day, if someone going to put it to you at 25, if and make you buy it at 25 if it's worth 24, yes, you're going to have a $1. In this case, you could either go back and you could buy this back for $1 and just be done with it, or maybe you're assigned and you have to buy the stock at 25 and then you sell it at 24. Those are two scenarios you could do. In this case, your loss would be $1 per share, but because you initially pulled in $1.30 per share, wow, this is crazy. You actually are still going to profit on this trade. So you had said if the stock stays above or even neutral, you're going to be okay. But in this case, even if the stock drops slightly below the strike price you sold, as long as it is within your safe zone of the premium you received, then you still potentially could close out with a profit overall. So in this case, your risk is going to be the premium received subtracted from the price that strike price you sold. So if you have a 20-25 put spread, in this case you have $5 at risk, but you're already receiving $1.30. Stock closes at $24, you're assigned the stock, you have to sell the stock at 24, or frankly, on expiration day, you just go back in and buy to close your 25 put for $1. But you're still closing out that profit of a net of 30 cents because you originally sold it for $1.30. Now, the reason why we choose a credit spread is because, frankly, wouldn't it be great to just hit enter and go into find a stock that's slightly bullish or even kind of neutral, and we hit enter and money comes into our account. Now they're going to hold a certain amount on margin, but you're going to start the trade with the profit. And the best part is if you can find a stock that's in a predictable type of pattern out there, you don't have to find a stock that's actually going to go up, because frankly that's very, very, very hard to do. And to find a stock that must move in your direction on your time frame is hard. And that's when we would, if we can do that based upon your advanced technicals or some of your charting patterns that you're learning, then we would just go in and buy a call. But we would choose a credit spread because cash is going to come into our account initially, and the stock can go up, sideways, or even down a little bit, and you potentially could still close out with some type of profit. Now, ideally, you think the stock is going to move, but you're not quite sure. I can't tell you how many stocks I have looked at that I think, yes, this is definitely a bullish move, but maybe the overall market's not bullish. So that might hinder the stock moving in the positive direction, or may not go up as much. So then you say, okay, I want to trade this in a bullish fashion, but because the market may not be as bullish as necessary, it may not move up. So I'd still like to enter into a trade that would be bullish, but you're not positive the stock is going to move, or you're not forcing that stock to move. And one of the great things about this is maybe you find a stock that is in a pattern, but you're not positive it's going to move. You can still profit by going into a credit spread, but also you can easily reverse this trade if you need to. What if this stock does go beyond a support and resistance and has a breakout the moment you enter a trade? This is a great way to actually go back in and take advantage of that direction. And I'll show you that in just a minute here. And of course, the reason why we always choose spread trades is because we're going to limit any losses here. We don't want you to put a lot of your dollars at risk, folks, especially when you are learning. It is very important to practice this on paper until you really get this. It took me many, many, many times to really understand how spreads work, and I had to go through multiple practice situations. So let's take a look. This is going to be our bull put spread. one of the best parts about this is we're going to benefit from premium or from time sold. So if we were to say, here's a stock at 51.92. Let's take a look at the options chain on our website. If you scroll down, you know the center of this is where your strike prices are. Now again, we are bullish here. So we are going to say, what is the price that the stock will probably stay above? And that's the price that I'm going to sell. We want to allow ourselves the best safety factor and probability of profit here. So we would like to say, if this stock can stay above the price that I sell, then this will not get put to me and I won't have to buy the stock. Ideal situation. So if your stock is at 51.92 and maybe there's a really strong support right around, say, $51 or even $50, if there's a really strong support right through here and you say, okay, I'm going to go ahead and sell the put down here at $50, that way the stock is allowed to go up, sideways, and slightly down, and I'm still going to be okay. So as we scroll down, we take a look at the strike prices. If I were to sell the $50 strike price, I'm going to pull in approximately about $2.05. So I'm going to pull in $2.05. What this is saying is, as long as the stock can stay above this price, I get to keep that cash. But now, I don't want to be exposed all the way from $50 down to zero. What if the stock gets really bad news, unexpected? You don't want to be in that situation. And I've been in that before, and it's always best to start out with some protection. So I'm going to have you go down here and say at the 47 strike price, we're going to have you buy some protection. Now you're not exposed from 50 from the stock's price all the way down to zero. Now you're only exposed from the price you sold to the protection you bought. So now to buy our protection, again, it's kind of like buying insurance on a house. We don't really even want to use this by any means, but we're always going to buy this because it's going to reduce our amount of money at risk. So now you're at risk between the $50 sold and the 47 strike price that you bought. So let's take a look at this. By us adding insurance on this, we're selling a premium for $2.05. Cash comes directly in your account. We're going to buy protection at the $47 put, and our net profit on this is 85 cents. This is a really nice looking trade because what do we have at risk? We have at risk the amount from 50 to 47. This is a $3 amount at risk, but we're already bringing in 85 cents. So the amount of money you have at risk is $3 minus 85 cents, which is really only $2.15. So wonderful way to enter into a bullish stock that maybe is expensive and that you say, gosh, if this just continues its normal trend, you're still going to make a very, very nice rate of return and you're not forcing a stock to move. In fact, we like to take a look at our credit spreads because we say, man, if this stock does go up, yes, I'm going to make some money. But maybe, again, you're not sure. Maybe the stock has had its run, but you're still in a bullish stance on it. So this is a great way to go in with limited dollars at risk and assure yourself the probability if it does head up, you're going to make a very nice profit. Also, even if the stock just stays completely sideways, in that last example, if that stock can stay above 51, I believe it was 92 or something like that, 51 some dollars, you're still going to, as long as it stays above 50, you're still going to make 85 cents per share profit on that trade. That stock can go up as high as it wants. It can go sideways, and you're still going to clear out a profit. And even better, even if the stock does drop even a little bit, you could still make a potential profit because you're allowing it. You sold your strike price to say, in that case scenario, as long as the stock can stay above the $50 range down here, then you're still going to keep the 85 cent profit. So that's one of the nice things about this is you're really allowing for the stock to have its normal movement. Now clearly when you're placing a trade like this, technicals are going to be very, very important. So we're going to take a look at a few things that you're going to want to do. So based upon our checklist, let's go ahead. We want to find a stock to trade. So we want to get a bullish looking stock. We're going to check the chart for our technical analysis, seeing where is our support, where is our resistance, where do we think the stock has the highest probability of staying above. So these two strike prices would expire worthless. Then we're going to choose our expiration date and strike prices. You don't want to choose too close because you want to allow yourself time for it to move in its normal fashion. And then our strike prices are also very important. You want to make sure that, especially if you're a conservative trader, that you're going to allow that stock to have all types of movements and you can still profit from those directions. So I'll show you how to place the order and monitor your trade. Again, it's your responsibility, folks. If you have cash at risk in the market, you need to look at this at least once a day after the market is closed to see, did the stock break out of its trading pattern, and might you need to close or alter that trade if necessary. So the first thing is to look for a stock. Clearly this is a bullish on the bull put spread, so we're always going to start with what's the highest quality stocks first. Maybe you go into the income traders covered call column and say, what is a stock that we have found that we think is fundamentally very strong and has a reason to stay bullish to neutral? Or some of the other stock picks. Guys, we're constantly updating our site on stock picks every Sunday and every Wednesday on stocks that all of our editors from around the world that write for us have chosen particular stocks, that the reasons why we think it might head up. Or maybe you have some of your favorite stocks that you have been watching and you think are very bullish. And of course, news can play a big part in this. We want to make sure that we get into something that has always good news on this. And one of the most important factors is new traders focus on, I want the highest rates of return. And frankly, that's not the safest way to trade. You always want to focus on what is the chart telling you. Don't use rate of return searches. Don't give me the highest rate of return because those tend to be the highest risk. If we can have you start out on the most conservative basis, saying, if I could find the best stock in a great industry, in a great market, then this stock should have the highest probability of me profiting my full rate of return. So it's always going to be based upon our technical analysis. And that's why we want to find a stock that is bouncing up off of a support area. And a support area, as you go through your charting and some of your advanced technical classes, you're going to see that the number one thing we are to look for in a stock is not necessarily the news, but the moment you enter it, what is the current trend? Because the current trend is the momentum of what that stock is doing. And we're going to take a look at what is the other indicators and what's our volume look like. So we don't want to enter when the stock is near a resistance area because we know that stocks will move in patterns. So if this is your stock's pattern and we are bullish, we know a stock tends to stays above support. That's great news. But this is a key area that it's okay for a stock to come back to support. What's not okay is for a stock to break its support. We don't like that. But we don't want to be entering a near resistance area, folks, because when a stock hits resistance, it tends to roll right back down. So we want to make sure that if it does hit resistance and it breaks above resistance on high volume, that could be a bullish entry. And we can always leg in, which means we could always potentially go in and sell our put first to receive a very high premium, and then as the stock continues higher, then we can buy our insurance. If the stock heads higher, 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 our put prices decrease, so our insurance costs less. But if you do decide to leg in to a bull put spread or a credit spread, the margin, if you go in and sell naked initially, so in this case, if you went in and you said, I'm going to sell a $25 put and I'm not going to buy the protection just yet, then when you're selling $25 put, you're going to have to hold margin for your naked position overall. Now your expiration date and your strike price, typically we want to look out for at least about 3 more weeks, because there you're going to get some good amount of time value. You're going to get some weekend premium, and the market makers will price in a lot of fluff or implied volatility. That's what we benefit as a seller of time. If you go too far out, if you go out 2, 3, 4 months, what's going to happen is as each day ticks by and as each day or each weekend goes down, 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 your premium should reduce. But in many cases, if you have gone too far out on your strike price that you sold, the premium does not reduce very quickly. So about 21 days to expiration, we're getting some of the best theta reduction in options premium. So that's what we're going to look for. And again, we don't want to sell near resistance because the stock has a tendency to come right back down overall. So look for breakouts. This is great. If you have found a really bullish stock heading up, 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 hits the resistance and starts breaking through that resistance, that could be a fantastic area for you to go in and start trading, start moving your strike price up. The strike price that you sold on a short put is the price you want the stock to stay above. So if the stock breaks through a resistance area, you can now say, I'm going to move my strike price up to sell at the resistance area, which becomes that new support area. Now, if you're going to be aggressive, you're going to find that as you start trading with us and different examples, you might find that we are more aggressive or more conservative, and it's not going to depend just on our personality, but it's going to depend upon the trade and the chart. For example, if we think that a stock has a very strong reason to head up in value, maybe for whatever reason, a strong sector, strong industry, great news, then normally we would sell an out of the money. We would allow the stock, as long as it can stay above this price in a bull put spread, we're going to make money. But if you think the stock really has a reason to move up, maybe you say, I'm going to sell a strike price here. When the stock is here, I'm going to sell a strike price in the money. I'm going to sell a put, and as long as that stock closes above the put value that I sold right here, then you're going to make some money. And the aggressive would be an in the money type of option that you're selling. Now, you would only do that when you're really good at your technicals. Conservative is out of the money, and we'll take a look at that. That's where I want you to start. It's the safest way, because now with a conservative out of the money option that you're selling, you're allowing the stock to move in all different directions. So taking a look at this, if we are picking a strike price for our bull put spread, obviously the most important thing is what's the stock's current trend, bullish to neutral, and then we have to choose the particular trading channel, use our support and our resistance, and you'll find that on our website. And that's why Mike does a fantastic job delineating the area of support and resistance, and the stock's trading channel and the average move is going to become very, very important here, folks. Again, we would like you to enter trades where you have the highest probability that you're going to profit, because if we can get you consistently making money, then you're not going to stress as much, and you're going to go, gosh, this is a very learnable, obtainable skill. And then as you get better, then you might move your strategy around, becoming more aggressive. So for now, your ideal scenario would be if this is your support area, and then here's your resistance based upon our charts, our technical indicators. The stock heads up, 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 heads above support, moves up slightly, comes down, and it confirms that it's going to hold that support area and starts moving back up again. Now, this is where we say, here's the resistance where the stock will probably hit a high point and then generally start to roll over. If we were to sell this particular strike price, we know that the stock could move a little bit to support, and as long as the premium that we receive is more than the difference between here and support, we will still make money. But you want to make sure, ideally, you can either sell it at support if you're conservative, or you can sell it maybe, here's your support area, or you can say, I would like to sell it slightly above the support area, sell my strike price right through here. That way, if the stock does pull back down in value, you have plenty of room, because your premium received will allow the stock to drop below the strike price you sold. Keep in mind, when you're choosing your strike price, the most conservative area is an out of the money. Now, once you've sold this, you say, okay, as long as my stock can stay above the strike price that I sold, then, and it can maybe even stay above resistance, above support, excuse me, and below resistance, then the profit will stay in my account. In fact, on a bullish trade, we'd actually like it to break through that resistance on the bull put spread. So every night, I want you to look at how to monitor this. Look for a potential reversal. Otherwise, leave the trade to expire as it is. If the stock is staying within its overall trend, bullish to bearish, up and down, support to resistance, you're going to be okay. You want this to expire worthless, best case scenario. Now, if there is a reversal situation, we want to make sure that you go in and take action. Either close the trade out if you do not know how to repair it. This is very important. We want you to protect what dollars you have at risk. But of course, we want to teach you how to repair your trade with your out-of-the-money put. Because think about it. If you entered into a bull put spread, you said if it goes up or sideways, I'm okay. Well, let's say for some reason stock is just really, really, really bad news and now starts to head down. And you go, well, crumb. Then I know I need to go in if stock just broke through major support and it's starting to head down, 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 down. Folks, when a stock is headed straight down, what's the number one investment you'd like to have to profit as it drops? Yeah, that would be a put. Well, the reality is you already own a put. You bought your protection put down here and you sold a put here. So if you entered into a bull put spread, you wanted the stock to be heading up or sideways. Let's say, for example, your stock breaks the support area and just starts heading straight down. If your stock heads straight down in price, then you're just going to go back in and repair the trade, and you're going to buy back the put that you sold, and you're going to leave the long put open. I'll show you this in just a moment. Also, maybe you didn't see this. Maybe you were busy and you didn't see that maybe on expiration day the stock could have gone up or could have gone sideways, but on expiration day it drops and it goes slightly in the money and you're assigned. All of a sudden you own the stock. Well, guys, if it's a bullish to neutral stock and you have great fundamentals, maybe you just hold on to that and sell covered calls. Keep in mind, on expiration day, guys, and this is why it's important for you to always be aware when you're entering into a position, what is the exact expiration day? I would like you to put it on your calendars, on your smartphones, whatever it is, and always take a look on expiration day. Are my options, do I need to do anything to take action? Will I be assigned? If you don't want to be assigned, then you can just go back in right before expiration and close out a trade. If for some reason you can't, the assignment will be automatic at any price above your short options that you sold. So this is the important part. If you are doing a bull put spread, if it's gone below the put price you sold, you'll be assigned, which just means they'll make you buy the stock. If you don't want the stock, you immediately sell it, or you can take the stock and sell a covered call on it. Early assignment is possible, but very, very unlikely. And keep in mind, folks, if you don't have the cash to actually enter or get assigned, the reality is in the options world, you don't have to have the cash to be assigned here. Because when we're trading options, if you get assigned and you don't want to get assigned or don't have the cash, you can immediately, because you have 3 days to sell that stock or to buy that stock. So you can immediately hit exit out or reverse that trade. Now, if you say during the period of time I'm actually trading this and my stock is bullish and I think it's going to do great, because stocks have trading patterns, and don't worry if the stock comes down to a support. That is 100% okay if a stock comes down to support, folks. What is not okay if we're doing a bull credit spread, if the stock comes down and actually starts breaking that support, that is not okay. Now in a bear call, which I'll explain in a moment, we don't want it above the call price we sold. So in a bull put spread, If the stock drops to support, that's all right. If it drops and then bounces off, we're still okay with that. But this is why you need to look at this every single day, because we want to make sure that it's going to stay above support, and especially if the support is broken and if there's some high volume, it tells you that there's a very strong technical area that the big money is saying that it's probably now changing its trading pattern and should be reversing. It's not going to go up or sideways. It very likely has a high probability of now trending down. And that's when you go back to look at your average move of what's our downward movement now and how many days, and where's our next area of support that we think it's actually headed to. So if support is broken on a bull put spread, you're going to buy to close the short put. The put that you had sold, you said, okay, if it goes below this, I'll buy the stock. You want to get out of that and you want to release the obligation. Now, you had sold a put here, but you had bought a put for protection down here in a bull put spread. So if you can release this obligation and buy this back, now you just own the standard long put, which is the best thing to own as the stock is dropping. So this is why it's important. If your stock has a high probability of continuing even further down to its next support, reversing by buying to close the short put and keeping the long put can actually turn out to be quite profitable if your stock is a big mover. Or maybe your stock isn't a big mover, and maybe your stock, so it comes down, it breaks your support, it starts coming down to the area, to the put that you sold. Maybe you sold this put and the stock comes down, excuse me, you sold this put right up here and then you bought this put for protection down here. The moment the stock drops through your first support area and then hits the price of the long put, and then maybe you're at a break even. Maybe you have a net credit on the trade of 38, 40, 50 cents or $2. Once your long put gets into a profitable position, or is it at least at a break even of where your credit was, after you've released your obligation and bought back your short put, then you would close out the long put. So what we're looking at is, if we see here's a stock heading up or headed sideways, and you go, I'm doing a bull put spread, credit spread on this, stock gets really bad news, starts coming down, 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 and you say, okay, I gotta get out of this one, I have to release my obligation. So you buy back this short put, you close out of this trade, now you want your stock to head down, so your long put starts to increase in value all the way down to its next support. And as you look at your technicals, you want to make sure you don't want to overjudge this and saying, oh, I think it's going to drop to the floor, I'm going to hold on to my long put forever. You can't do that, because keep in mind, you now own a long put. You're going to have an expiration coming very, very quickly. So sometimes once you just get to that break even point, that's the best way to stop out. Close the long put, take your break even, and then move on. Let me show you what that looks like here. So here you have, if we found a stock that was kind of in that neutral pattern, really good fundamentals, we say, you know what, maybe it has a strong bullishness potential coming up. So you'd go in and we would say, where's the support area? I'm going to go ahead and sell where the stock's support area is, right on 27. I'm going to go ahead and sell a bull put spread because I think the stock's going to stay above this area and head higher, or at least move back to its resistance area. So if you were to sell the 27 put and buy the 25 put, maybe you get a net credit of 75 cents, which means you sell the 27 put for a larger premium, and just so we're not naked, you buy protection at 25. So now you're only exposed between 27 and 25. Your margin is $2 less what you've already brought in of 75 cents. So your margin is really only $1.25, which is absolutely fantastic. If you're getting a 75-cent credit and you only have $1.25 at risk, that's a fantastic rate of return. And the reality is, you just need your stock to head sideways or up. But now, so you enter the trade, you're really excited, you said, I got a great trade. Sure enough, the moment you enter it, the stock finally breaks a support that it hasn't broken in a long time, and you go, what? Now what do I do? Well, we know you have a total of $1.25 at risk because difference between what you sold and what you bought minus the premium. So folks, what's your break-even price right here? Let's see how much you're understanding on this. If you sold the 27 put and then you bought the 25 put, so you're only exposed these $2. But you've already brought in 75 cents, so we know that worst case scenario, if we take the strike price you sold, which was 27, and subtract the money you already brought in, which is 75 cents, that's where your break-even price would be. So if the stock goes to 27 minus 75 cents, which in this case would be $26.25, anything above that, you're still going to be clear out okay. And on expiration day, you could just go back in and buy your 27 put. As long as it's less than 75 cents, you still make a profit. But let's say, no, that doesn't happen to you your first time. First time what happens is it starts dropping and dropping and it breaks a major support area. It comes all the way down to 25 and it breaks it down to 24.50 and you say, what? I don't know what to do here. Well, you could just close the trade and you're going to have your $1.25 overall at risk because you pulled in your 75 cents. But then you say, well, wait a second. This thing just got a hammer type of formation or a bullish formation through here. So I know that I could probably go in and maybe I could push this out. Maybe I could actually extend this because I think the stock just came down to a super strong support, getting a reversal, and it's going to head back up. I just need more time. Well, let's take a look at this. You could buy to close the 27 put. You could leave the 25 put opened. That way, the more the stock dropped, the more premium you would get. But let's say the support isn't too far away from the next support isn't too far from the 25 put, and you don't have an opportunity for really huge growth. So that's a possibility. That's why your technicals are so important when entering into any type of trade. And so the stock hits the next support or break even. So maybe the stock comes all the way down to the next support and you say it's not dropping anymore, then you get out of your 25 put. You just step out of that point. Or maybe you're at a break-even point. If the stock stops falling prior to support, maybe you think it's going to be coming down, breaking this area. Here's your 27, here's your 25. You sold the 27. You bought the 25, stock comes down, 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 down. It breaks your areas to support, but then it kind of stops falling. Then at that point, either it's going to bounce, head up, obviously head sideways, but we don't think it's headed down anymore. So what are your choices? So this is where we think, if we think that we're getting a bullish indicator here, and you said, man, if I just had a little bit more time, I could hold till it moves back to resistance, that's when you would consider rolling out of this trade. By that means is, by rolling out means you know that the stock is moving in its pattern and it's kind of bullish. The moment you get into it, it breaks a support, but that was just a piece of news and it's starting to come back up and we're getting to expiration and you need more time, then you might want to just buy to close your entire spread for that particular month. And because you look at it and go, well, I only have a few more days and it's not worth actually unwinding it. There's not enough time for my long position to actually move in order for me to profit. So you would buy to close your entire spread, and then you would look to say, how do I just push this out to maybe another month or so, so allowing this more time to move back into its fashion. Because folks, if you notice, expiration day is the third Friday of the month on the monthly expirations. Many times stocks will stay in their patterns and then on expiration day they'll have a really unusual play and then 2 days later, Monday or Tuesday, bam, it's right back into its trend. That's a very interesting coincidence. Market makers know that most people who trade options don't know what they're doing, and so on expiration day, would they possibly come and swing this down so people would panic and lose? beginner folks who don't educate themselves don't know that you could just easily roll it out and you could become profitable in 2 more days if you just rolled it out. So sometimes on market makers, what they'll do on expiration day is they'll manipulate the price a little bit. So if you are buying to close the spread and you say, I want to immediately sell to open the following, that same day, Friday or Thursday before expiration, many times the market makers will not give you the largest amount of premium because they know that people are panicking. So you might wait until Monday or Tuesday before you go back in and sell the same strike prices just out 3 or 4 more weeks. Because Monday or Tuesday is when all the end of the month panic is over, and folks now are taking a look for the next 4 weeks. So market makers will inflate the premiums back up again on Monday or Tuesday. So many times you will see us probably do this if we have to roll out of something on our trades, is we buy to close the spread and we might wait Monday or Tuesday before rolling back in to get a higher premium. Then you want to sell to open the next month's spread, and by doing this, selling the next month, so you're buying to close the current month, you're going to sell to open 4 more weeks of time. Because of that, you should be pulling in some theta value that will decrease into your account, helping you offset any credit that you had received, your credit you received, and you had to pay to get out of it. Now you're going to pull a credit back in, and now, but you see it bouncing up in value. So you're allowing yourself plenty of time for the stock to go back into its trading pattern that you anticipated. If you think the stock will stay in the same trading pattern, you can sell the exact same strike price for just the next month out to pull in your 4 weeks. Or if you think the stock is now headed higher, you could actually sell maybe the next higher set of strike prices, pull in some intrinsic value, and pull in a much larger premium. Folks, keep in mind, we trade because we're taking advantage of movements in the stock. If we see the stock heading to a strong support area, heading up in price, you can either buy the stock, which is expensive, you can buy the call on the stock, but that's also expensive because you have to pay for the implied volatility and the theta. But if we were to sell an in the money put, receive a very large premium into your account, then if it bounces and heads up in value, the put is going to decay away and reduce in value. You could actually go back in and buy this back. Now that's a little more advanced. Maybe you'll learn that later on, but just keep that in the back of your mind, folks. And when you go to your advanced options class and start learning that, you'll see us do that example over and over again. It's one of my favorite ways to trade. So what does this look like? Let's go ahead and we're going to buy to close the initial trade that we had sold. So maybe we sold this 27 put. We're just going to go ahead and reverse and buy to close that. The same number of options you had sold. And then we're going to go and take a look at our protection. The protection we had purchased for on the 25 put, we're going to go ahead and sell that if it's worth anything at all. Now, remember we initially pulled in, I think, 75 cents. And you go, man, it's going to cost me to actually get out of this. Well, it's okay because we're going to roll this order. Remember when you went into this trade, you knew that your technicals and fundamentals were very, very good. And so you said, I just need a little bit more time. So buy to close the order. Then you're going to go ahead and then say, I would like to place an order to sell to open the next month. I'm going to sell the same strike price of the 27 put. I'm going to buy the same protection, so I'm limited dollars at risk. Same strike price, just 1 month out. But this time, because you're selling 4 more weeks of time, you actually are going to pull in a little bit larger credit here. That's a big bonus. Because not only are you pulling in, giving yourself more time to turn this into a profit, but you've actually pulled in more premium here. So now you've taken your original trade and your credit is even larger. So let's take a look. This is called a rolling credit. Our first trade, we entered the bullish credit spread, bull put spread. We sold the 27 put, bought the 25 put, $2 on margin, but we received 75-cent credit. That's great. Now the second trade, the stock broke through support and was headed down, but it wasn't headed down enough. It hit this a lower support, got a bullish indicator. You think it's headed right back up. You just need more time, so you're going to go ahead and then you're going to buy to close the current spread that you sold to open. To buy to close, it's going to cost you $1.10. Then you're immediately going to go in and roll it out for just 4 more weeks. You're going to sell the 27 put, buy protection again at 25, but this time, because you're selling more time, you bring in a larger amount than what it costs you to close it. So overall, you've just extended another month of time to allow yourself to get back into a profitable position, but now you've just increased your profit potential on this trade. Now we do this because we don't want to take a loss, of course, and you know what? Maybe in 2 or 3 or 4 more days this stock did get a bullish reversal and start heading back up. Maybe you go back in, worst case scenario, when this stock goes up and hits a resistance area, you can maybe go back in and buy this for a small amount and then just be completely done with the trade. Keep in mind, as traders, we don't have to hold until expiration. We like to hold until expiration if we need that time, or as sellers because we're receiving premiums into our account. So the key here is, where's your support and where's your resistance on the chart? Now, I also want you to take a look at maybe when you're looking to buy to close. Let's go back to buying to close. Maybe you buy to close the 27 put. But guys, if the put that you had initially sold, if this one is worth virtually nothing, you may not need to go in and actually buy that back. You might just say, you know what, this is worth nothing, so maybe you just go back and buy to close the one you had initially sold at that point. So if you buy to close the one you sold, and then sometimes this is what I like to do if it's a lower priced stock. So let's say you bought to close the 27 because maybe the stock is at $26.50 on expiration day, and you go, I know, or excuse me, $25.50. Let's say $25.50 on expiration day, because you know that the stock is headed up. You see a bullish move, and you go, I'm not taking my loss, because many times, really just a matter of days, the stock has just bounced right back up. So you go back in, your 25 put that you sold is worth nothing, so you go back in, you just buy that 27 put that you had sold initially, just buy that back, and then you sell 4 more weeks of time, and you go back and say, I'm just going to sell this 27 put, but because it's a lower price stock, maybe you have money in your account on margin, and you can hold a larger portion in your account so you don't buy your protection just yet. So maybe you buy this back for $1.50 of intrinsic value on expiration day right through here, and then maybe you sell this for an entire $2.50. This is a buyback and roll out, but you're going, in this case, maybe you go naked because you go, I see that this stock is really heading up in price, and I think that it's going to go right back above 27. You go back in and you say, as soon as I'm at a profit right here, you actually buy to close. That's something to consider. You don't always need the protection if you're a little bit more advanced and you've done this several times, and this is why your paper trading is really so incredibly important. Folks, maybe while you're actually doing this trade, maybe you go in on paper, and maybe as you're selling to open your trade, and you buy to close and then sell to open again, maybe you sell this one to open to roll out for 4 more weeks, but on your paper account, maybe you go in and also sell a naked and just see how it does. Once you're good at your technicals, you'll be able to enter into naked positions, and I know that sounds scary to people, but maybe you enter into a naked position, but you say, okay, maybe I'm going to sell a lower strike price at $26 and pull and just sell that naked. So you pull in a larger premium. Maybe you pull in $2.10 of a larger premium, but now the stock only has to go above 26 and not the full 27. That's a buyback and roll down. So these are things you'll learn as you practice, And sometimes the week right after expiration, like I said, the Monday and Tuesday right after the expiration, the market makers really tend to just balloon those prices on the option premiums again. And as an option seller, that's where we make our money, is in the option prices, as they it's that implied volatility. When they go in and blow up these prices, as a seller, we love to sell overpriced options. And the reason why we go into spreads is because we like to start the trade with a profit, but when you're new, we don't want to have a lot of money at risk. We want to have very, very limited risk. So that's a bull put spread, which is a credit spread. Now I want you to consider a bear call credit spread. So the bear call credit spread means you'd like the stock to stay below a resistance area. So maybe you have a stock and you say, oh, I find a stock that's kind of sideways or even probably heading down overall, one of these two areas, and you say, heading down. So you say, okay, I think the stock is going to stay below this area of resistance. So you're going to sell a short strike price right above resistance area. And because we don't want to be naked, we're going to buy a higher strike price for protection on the call you sold, so you're not naked. For instance, let's take a look. Maybe we see that this stock is starting to break down, and we see, gosh, we could benefit as it comes down, but maybe you're not sure it's going to drop, so you don't want to buy a put, because maybe you say it's going to drop, or it has, but it could stop right here, but I definitely don't think it's going to be heading up above resistance. So again, we want to ask ourselves, where is the stock not headed? If I don't think the stock is headed up here, let's see if somebody would pay me money to sell a call option here. So that way, say, as long as the stock stays below the price that you sell on a bear call spread, you get to keep all that premium. So we're going to enter into and sell, in this case, a $30 call option. But now you're saying, okay, someone can take the stock away from you at 30. Guys, you don't own this stock. So you're going to go in and buy some protection on the next strike price, just in case the stock does go above your price that you sold. You have an obligation to deliver the stock. You're going to go in and take the stock away from somebody else at your protection. So maybe you go in, you sell the $30 strike price, and you say, okay, if it goes above 32, I can go in and take it from someone else at 32 up here. And you're only doing this because you're saying the likelihood of the stock staying below the price that I sold here at 30 is very, very high. So if you were to sell the $30 call option, you're going to pull in a premium, and then we're going to buy some protection at 32. So maybe we sell this at 50 cents. And then we buy this protection for 15 cents. I mean, frankly, that's not bad, 15 cents. So we buy protection at 15 cents. We bought that. We received this. We're going to make 35 cents here, folks. I know it's not a huge amount, but man, the likelihood of this stock staying below your strike price of 30 is very, very high. So if we could actually go in and pull in an extra 35 cents as the stock is now maybe staying sideways to downward trend, that might be a nice trade. So an ideal scenario is the stock would close below the strike price you sold. Again, we're saying, where's that resistance area? Where's the stock not going to be headed in this next period of time? So you always look at your average move. Look at the trend, maybe 6 months to even 1 year, and see if the stock is not headed in a overall uptrend. So both options expire worthless. Keep in mind, in a credit spread, the best thing about credit spreads is we start the trade with a profit, and we want the option that we sold and the option that we bought to both expire completely worthless in our account. So no further action needs to be taken. And the reason why we like this is because, did you know one of the hardest things out there in the market is to find stocks in a great strong upward trend? Because the best of the best of the best have a really hard time finding stocks in an upward trend. And that's why the website's so great, because we're going to help filter through a good stock in a good sector in a good trend. And frankly, Many folks are really, really good at finding stocks headed nowhere or actually headed down. And so you can actually take your skill that you have of finding stocks headed nowhere or even down, but now we can profit from this. We can actually sell and pull in a spread pull in a spread that's a credit initially and no extra commissions to close the trade. You just say, man, as long as this thing can head sideways to down, I'm going to be totally okay with this. So let's take a look at what we'd like a stock to do. A bear call spread is when we say if we think a stock is headed at least sideways or even down. And like I said, most people, it's really, really hard to find the one stock that's headed up. So most people tend to be very, very, very good at these bear spreads because you find a stock that you love, but kind of the good quality stocks a lot of times are just kind of neutral or in sideways channels. So we would enter into a bear call spread. And so you'd still make money if it goes sideways, you'd make money if it goes down, and you potentially could still make money even if it went up, as long as it stays below a resistance area or it's below the strike price you sold less the premium you received. So why do we choose a bear call credit spread? Because again, you're going to start the trade initially with a profit. We're going to sell a lower call and buy the higher call, and the net profit goes directly into your account. This is really the best part, folks. Most people have a hard time trading the stock market because they think, oh, the stock's got to move. And the reality, the reason why we really focus on spreads and our cash spreads when Mike does his fantastic S&P trade is because we know that the stocks are going to move and that we just want them to do what they normally do. We want them to move in their original overall direction. As long as the stock can stay in its original direction, which is saying I want the stock to stay in its original direction of its neutral pattern, support to resistance, you're still going to make money. You don't have to stress at night saying that, oh, it better go up or it better go down or it shouldn't do this. And we want you guys to enjoy life. And this is the type of money we were looking for, these consistent trades. This is not the big money type of trade. It's the consistent profits with a high probability. And we also know that, man, maybe if this stock for some reason gets really good news the moment you get into it and it breaks strongly above the ceiling, you can go in and you can easily reverse this trade. We're in a bear call spread, so if the stock for some reason doesn't move to the sideways or downtrend but all of a sudden gets really, really good news, you can go back in and easily reverse this trade. Because think about it. When a stock heads up in value, what's one of the most profitable things to own? That would be a call option. Well, if that's the case in your bear call spread, in fact, let's just put it as bear call spread, say it this way, now we know that, well, we have calls. If the stock does actually go into an upward trend, then we just take our bear call credit spread and we buy back the option that we had sold. And now we just have a long call, so if it does tend to go up, we can reverse this and we now own a long call. So if the stock goes sideways, your bear call spread is going to have a profit. If the stock goes down, everything expires for a full profit. But if your stock gets really good news, breaks through resistance, and you think it's still going to really head up, fantastic. You're in a call spread. You're just going to go in, buy back the call you sold for whatever that value is, and leave your long call to continue to run up. Why do we choose this? Because great news, we start the trade with a profit. Once the money goes in your account, typically 24 hours from options trade, you can move it to your checking account if you need to pay some of your bills. Stock doesn't have to move, or maybe you think it's going to move, but you're just not positive. And we really liked to know that we're entering into spread trades because we have limited dollars at risk. Limited dollars at risk is going to really allow us to go in and maximize our dollars, our rates of return, and really reduce our dollars at risk. When you learn about trade management in your cash flow live sessions coming up, that you'll be participating in. We're going to talk about trade management, and that's very, very important. Not to invest too much, not to invest more than typically, 2% of your account. Now, if you have a tiny account, a couple $100, you might have to go beyond that. But as you go through our other education steps, you're going to talk about money management, which is very, very, very important. So money management and technical analysis, and then how do we maximize our profits based upon using our spread trades with our limited dollars at risk here. So checklist, we got to find a stock. Now here you want to check the stock for maybe a bearish stock or bad fundamentals. You want to check the chart for your technical analysis, see what's breaking to the downside. One of my favorite ways to look for a chart is to go into the sector charting. And if I can go into the sector charting by going to the website, here I go to the stock scanner, and the stock scanner page, what it's going to do is I like to scroll down this page, and if I'm looking for a bullish stock, say, well gosh, what's happening right now? These are good stocks. Okay, look for a good stock in that sector. But man, if I'm going to be looking for a bearish trade, I want to scroll down. Ooh, this one looks good right now. And it's going to depend upon when you're watching your videos. Ooh, here is a fantastic sector that's actually headed down. So now when Mike built this, I just thought it was genius, because he said, this is exactly what's happening at the moment you step into this. He said, well, if we know the entire sector is headed down, what are some of the bad stocks in the bad sector that's headed down? So maybe you click on that and you go into your sectors of your stock scanner page. We scroll down to the oils, which at this moment in time of this video, some of our bad stocks. Let's just scroll down the page and see what's actually trending down. Here's one trending down. So it's a bad sector and a stock trending down overall. That's one of my favorite ways to find a bearish stock. Now again, many people, they're very, very good at finding stocks headed downward. And so you might find that this is a better strategy for you than bullish strategies, or when the stock market's in a neutral or bearish trade. So find a stock, check the chart, your technical analysis, where's your next support, your resistance. Make sure your expiration date and strike prices are within reason. We want to make sure that they're going to pay you money to actually do this type of trade. So you want to choose a strike price. Now the important part here is your resistance. We want to make sure your stock stays below, because this is a bear trade, below the strike price you sold. Placing your order, monitor your trade. Placing your order, you're going to sell to open the lower strike price. So as long as it stays below the price you sold on a bearish trade, then you're going to keep that money, and you always buy protection, and that's why we go into the spread. Then monitor your trade, folks, every single night once the market is closed. I want you to always go in and see, did it break a resistance? Did it break a support? Do I have to go in and alter or change this trade? Is there, do I need to protect my dollars, or is there potentially more money to be made from a breakout or a breakdown? Your expiration date and strike price, keep in mind, we always say we'd like to sell the best premium that has the best decline. Theta decline is about 3 weeks or 21 days to expiration. Again, if you go too far out, remember, you're selling time, but man, you're not getting that much. You're not getting that much depletion as it drops and drops and drops. Because if you frankly have an option that expires months out, then you're not getting the largest amount of theta decline. And as a seller, that's where we make our profits, mostly from selling time. We don't want to sell a stock near a support area, and the reason is because we know that when stocks go from the ceiling down to support, we need a stock to stay below the strike price you sold. So we're going to sell this call, and we want it to stay below this area of resistance. And many times stocks that hit resistance come back down to support and then move right back up. If you sell it near a support area, we know there's a very high chance that stock's going to go back up to that previous resistance area. So we're looking for the safety factor here, guys. This is not a greedy type of trade. You buy your protection up here, and we're going to sell. As long as it stays below this price, anything at or below is a pure profit for you. Oh, and look for a breakdown. Maybe the stock comes down. Maybe you found a great looking bad stock and it comes down, 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 breaks support, and you're like, wow, I am good at finding bad stocks here. So, what you can always do is, now this is a little bit more advanced, and we'll talk about this some more in your advanced options, but for now, you can actually buy this back and then resell the next area. This is going to be your next area of resistance because it was your support, it broke support, and now it's the new resistance. As long as it stays below that, this would bring in a much higher premium. So look for a breakdown below support on volume and now use that to sell your short call. Again, a little bit more advanced. At this point, you can either stay with step one, as long as it stays below the original strike price you sold, that's a pure profit. But if you want to take it a little bit more advanced and be a little bit more aggressive with that, maybe you sell an in the money strike price. Meaning, let's say you have your stock, here's your support, your resistance area, resistance support. You know it's headed down, 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 and you say, okay, so the stock is right here at maybe 50, let's just say the stock's at $51. Stock's at 51, and you know this thing is getting really bad news. It's in a downward trend at all. And you say the stock's at 51, but I'm going to go ahead and I'm going to sell the $50 call in the money because you're going to have $1 of intrinsic value. So your premium is going to be very high. And if this stock does come down and breaks that intrinsic value that you received by selling it in the money call, as the stock drops further, that's easy, that's a faster profit. Now again, it's more aggressive. You have to be very, very good at your technicals and look at some of your advanced patterns to do that. If you're conservative, then you want to say, where's my support? Where's my resistance? Here's my resistance, here's my support. You want to say, as long as it stays below resistance, then I'm okay. Maybe you want to go way, way, way up here, way above support, just in case. And that's why you take a look at what's the stock's average move. If it does break, does it still have room to move, and I'm still okay? And that's why Mike is really good at his cash spreads that he does, because he always is taking a very conservative viewpoint here. Now, if the stock does break a resistance area, you're going to buy to close the $30 call that you had sold to open. So remember, you had sold the $30 call. Let's say for some reason this stock gets a piece of news, it finds the cure for cancer and just skyrockets up. So you're going to go in here and buy to close the call you had sold. So remove this obligation. So you're not obligated anymore. Now you have the 32 call. You have a long call up here. As this stock increases in value, your 32 call should increase as well. That's an ideal scenario if you are looking to change out of this. So taking a look, if the stock breaks the resistance, you want to adjust, you can go back in, leave the 32 call open, stock hits the next resistance, or if you're at a break even, just sell the long call. If it has stopped moving, if it has broken out and stopped moving, immediately sell your 32 long call. The reason is because remember, you sold a shorter time frame. You don't have a lot of time for this to move in your direction. So once you're at a profit or a break even, and it's especially at the next resistance, then sell to close your long call. Maybe the stock stops moving higher just before it hits resistance. Sell to close your long call. Keep in mind, the one mistake people make when buying or leaving a long option open is the fact that they think they have more time and they always run out of time. So, bear call credit spread review. Folks, this is when we're going to take a stock, we're going to sell it at a resistance area. We're going to say, okay, as long as the stock can stay below this area, and again, I want you to say, based upon the stock's pattern, where is it not headed? You want to sell this area where the stock is not headed at all. And you want to find a neutral to a downtrending pattern. And this allows us to always profit from 3 weeks at a time, 6 weeks at a time, 6 days at a time, whatever your time frame is. We profit and we sell time. So on weekends when we're sleeping, we're still making money because we have sold time. This is a bizarre strategy to folks who haven't learned this, and they say, "Oh, you're crazy." No, I'm profitable. But you have to be very smart about this. Don't let greed be part of your decisions. Let your technical analysis and logic be part of your decisions here. We can reverse this into a bullish stance if it breaks above the resistance area. And that's why you'd enter a bear call, is because you say, well, just in case I'm wrong, I can reverse this. And if this stock does get really good news, then I have my long call. I can unwind and buy back my short call and leave my long call open to increase in value. Ooh, this is one of the best parts, guys. This is kind of key. Maybe you find a stock, and this is just super exciting. Maybe you find a stock that you say, I really think it's headed below this resistance area. But then you say, I think a stock is actually headed above this support area. So you sell calls and then you sell puts. So you bring in money up here and then you bring in money down here. So maybe you put a bull put spread and a bear call spread on the same stock. And as long as the stock stays within this pattern, you're now pulling in money from this side and money from that side. So we'll talk more about that type of a cash spread that Mike has really, really perfected. And the nice thing is when you do that, there's no extra margin needed between your dollars sold and the strike price you bought. And you can always roll out for more time. If you think, gosh, I'm so close, I just need a little bit more time. That's one of the best things about this business. Again, you can buy to close, and maybe that day or a couple days later, just roll out and just pull in more time and allow the stock the potential move in its average time frame to get to a profitable position for you. This is the thing about rolling out options. A lot of people say, you know what, just exit and take your loss. And the reality is, this is why when Mike was teaching me how to go in and trade the options market from my viewpoint of being a broker, it really was significant because he said, Stacy, we don't take losses. We're not going to just buy and hold and wait for these to continue to move up, long term, because we could be missing out on profits. But we're not going to just take a loss and just get out every single time. There's got to be a way to fix this. And that's really what, we're kind of following the direction of other traders that have gone before you. And you're learning from our years and years and years and decades of experience here, folks. And as we continue to learn and share our ideas and strategies with you guys, we want you to share your ideas and strategies with others only once you get good. Because yes, we're all going to be champions, and we're going to keep playing until you get it right, because we know this is a learnable skill. We know the market can only head 3 directions. So part of your job is to start participating in our weekly Wednesday classes and our Tuesday live trading classes and our Thursday group coaching classes. Write up your own checklist to get started. Start your own trading journal. Very, very, very important. Maybe you read the Income Trader, the Trading Tools Market Commentary Wednesdays and Sundays. See what our stock picks are. And practice trading some stocks, guys. Nobody ever went broke paper trading and practicing over and over and over again. I traded hundreds and hundreds and hundreds because I thought, you know what? If people are making big money at this, I know for a fact I can make big money at this. But I must start out with consistency first. Consistency is the most important. Once you have your consistency trading your stock picks, you find your strategy that you are very good at. Once you find that, then you go in and then you start with your money management, risking 2% or whatever of your portfolio. And you'll learn that in your Wednesday night classes. But then you find your strategy, and then you can start saying, okay, as I'm getting my consistent money, how do I now focus on different strategies to get the big money out there? And your Tuesday live weekly trades, these are great because it's going to help you take away the stress. You don't have to always look for a brand new trade on your own. Trade with us. And not that we make recommendations, we're an education company, but if we're going to show you a live trade that we're actually doing, you might say, hey, that might be a great trade for me to participate in, whether on paper or for real. And really, folks, we want to make this as fun as possible. And I know making money can be fun as long as it's not laborious, but it's fun because we're learning a new skill that'll really advance you for the rest of your life. And don't try to go out there swinging for the fences. I want you to go out there, if you can just get a base hit and a base hit and a base hit, then that will really start to add up. It takes the pressure off. And read our archived articles and use our glossary. Mike has just added so much into this website, folks. It is just a fantastic resource for you to learn one step at a time. Take the pressure off yourself. I actually got color-coded index cards, green, pink, and white. I would put all my bullish strategies on the green index cards. I would put my bearish strategies on the pink index cards and my neutral strategies on the white index cards. And that helped me tremendously to say, okay, if a stock is bullish, pull out my green index cards and see which is the best trade for the highest probability of profit with the lowest amount of risk based upon the stock's average move, based upon the technical indicators and the market conditions. And I really use that as a learning, as a visual person. What you're going to see as you continue on with us, this is just the beginning of your learning. We're now going to solidify everything you have learned. We're going to put it into place, and you're going to become a great trader, guys. But keep in mind, you have to do the work. We're here to support you. We're here to trade with you. We're here to encourage you, and that's why the Thursdays are important, your group coaching and all your trading. But you have to show up, guys. So I wish you fantastic success. I will see you in some of the webinars. And just keep in mind, we're for education company, and our job is to teach you that there's risk in the markets and how do you go in and how do you trade the markets with the least amount of risk and the highest probability possible. So folks, have fun, good luck, and the best part is you can hit repeat and listen to this over and over and over again until you really have it, guys. Good luck, and I'll see you online. Goodbye.